Are you looking to grow your business but not sure how to finance it? A business loan could just be what you need, but with so many options out there, it can be difficult on how and when to get one. This is where I come in. In this video, I will guide you through the process of getting a business loan, from determining if it's the right option for you, to understanding the different types of loans available for you, and the requirements to qualify, but also determine which lender and loan product is best for your business and your unique needs. Before we jump in, don't forget to like, comment, and subscribe so you don't miss out on any of this game-changing information. And if you watch this video until the end, I will tell you a great lender that you might want to check out for a business loan. Determining when it's appropriate to get a business loan is mission critical. This is why you have to understand cash flow and working capital. What I mean by that is, if you are going out and you're ready to get a business loan, you got to be prepared to pay that loan back. So understanding whether or not you have enough cash flow to pay that loan back is important, and understanding how much working capital you are going to need. Because the thing that you ultimately want to do when you're getting a loan is you want to make sure that there's some cash flow coming in, and you're marrying that cash flow with some of the loan amount so that every single month you can meet your expenditures and not sink. That's very important. Cash flow means having money come into the business so that you are already in revenues. That means that your business is already starting to make money. If you go out and you get a loan and you don't have your business in revenues, you're going to be utilizing that loan faster. So it's important to really understand, am I in revenue yet? When will I get into revenue? And you gotta understand this, how you're going to utilize that funding. How you're going to utilize that funding. And I cannot say that enough, because I have seen so many business owners go out and get a loan, but they don't have a use of funds schedule. And when I say use of funds schedule, I'm talking about how is that money that you're going to get your business to where you're trying to go sooner rather than later. Allow me to give you an example. Let's say I want to hire employees and I'm going to go out and get a loan for $50,000. The questions that I got to be asking myself is, how long is that $50,000 going to last for me to be able to pay those employees? Number one. Number two, what are those employees going to be doing so that we can get more revenue sooner rather than later? Because that loan coming into your business is not to pay your personal rent. It's not to pay your personal car payment. That loan has to be doing something that is going to get you moving further, faster. As another example, you will get funding if you need to buy equipment. Why is that? Let's say that I'm in the logistics business and I need to get a van. I need to get a truck. That truck is going to allow me to deliver those packages. That truck is going to prevent me from being on the side of the road broken down, right? It's going to allow me to do business. So if it allows me to do business, that means I am going to be able to make revenue. And revenue then extends the length of time that money is going to be available for me. And this is important. Making sure that you're not getting a loan just to pay bills, that you're not getting a loan just to cover overhead is important, because if you're doing that, you're going to sink your business. You're going to sink your business. So many business owners got loans during COVID, and trust, I understand why they did that. But if you get a loan without a strategy on how that loan is going to carry you to the next level, you're going to sink your business. And that's what you don't want to do. So you got to have the proper expectations of how to utilize that loan. Many times I will see business owners go out and get loans, but they're not really thinking long term. If you get a loan, this is an opportunity to build a relationship with a creditor. This is an opportunity to show a creditor that you can pay them back on time. And when you are improving your company's credit profile, guess what happens? You are now working with a creditor. They're now looking at you paying timely. They're going to then extend you even more money. So one of the things I want you to realize is that when you go to get a business loan, maybe in the beginning, you're only going to get $25,000, and you're really not getting it because you need it. You're getting it to build your credit profile. You're getting it to build that relationship with the creditor because you really need 100 grand, but you're going to go after the 100 grand maybe 6 months later, 9 months later, when you've built that relationship. So it's very important to understand that. Now, here's the thing, that when you are going after a business loan, you gotta really understand the risk involved and understand the stage of where you are in your business. Sequence is important. Allow me to give you an example of what I mean. If you are developing an app, for example, and you know that you are going to be maybe a year out from having that app completely developed, right? But you know when it's developed that you are going to have people wanting to buy it, or you know it's going to make you a ton of money, then you have to say to yourself, I'm at a growth stage, a development stage in my business, and I am not necessarily going to be able to pay that loan back anytime soon. That means that as I'm using money from that loan to pay my developers for that app, I also got to be using money from that loan to repay the loan. So you're using the loan from two sides. You're losing the loan from side one to pay your expenses, and from side two to actually make the monthly loan payment. So you got to be looking at how long that loan amount is going to last you before you get into revenues. So that's when you're in the development stage, right? You're not yet in revenues. Now when you're in revenues, you have some revenue coming in that's going to help you now cover the monthly bills, right? Now you're in that next stage where you're in revenues, but you're not quite in profit. You're not profiting yet. And that's okay, because when you are growing your business, there's different stages. Development stage, now you're in the revenue stage. The third stage is now you're starting to get in a profit stage. That means that not only am I making profit, I am going to be able to take some of that profit, set aside some savings first as you're paying back the loan. But now, as my profit increases, I can take that profit and start paying back the loan. So you really got to think about the stage you're in when it's time for you to get your loan. Different business loans have different types of features. So one type of business loan could be where they lend you money that you have to pay back over a certain period. Maybe they allow you to pay it back over 5 years, 7 years, 1 year. That means that you have an end to when you have to pay that loan back. There's going to be a time period, there's going to be an interest rate, and that's a closed loan. It has a term, it has a rate associated with it. Is that the type of loan you want? Or do you want a line of credit for your business? A line of credit for your business says, I have a line open and maybe the bank gave me a $50,000 line. I don't have to use it all at one time. I only get to draw down on it as I need it, as I'm paying it back. So let's say, for example, I get a $50,000 line of credit. That means the bank has said to me, Carla, we will allow you to use up to $50,000. Doesn't mean I have to use it, but it's sitting there. And let's say I decide I need to take down $10,000 of my $50,000 line. That means that of my $50,000, I'm going to use 10. I still have $40,000 available, but I'm only going to need to make the payments on 10 grand. Lines of credit are typically for those businesses that are in profit and they can manage themselves pretty good because you're using money, you're paying it back, you're drawing down. There's a lot of moving parts when you are using a line of credit. There's a lot more flexibility when you have a line of credit. So your capital, the money available on a loan, capital is fluctuating. Your capital needs are fluctuating. You don't have a hard amount that you actually need, but you do need to have a line of credit. I feel like every business should have a line of credit, especially when they have employees, especially when they have to make payroll, because you never know when things are going to happen. So that line of credit is there in the event that you need to access money. Understand how SBA loans work. These are loans that you get from the Small Business Administration. Now, when you are starting off your business and you may have a business that's capital intensive, meaning you need to purchase equipment, meaning you need to get a building, meaning you need to buy inventory. When you have a business that is capital intensive, the Small Business Administration will give you a loan and allow you to go out and purchase the capital that you need for your business, the equipment, the inventory, the building. However, when you get an SBA loan, that loan is typically secured by the things that you are purchasing. And I really do think that SBA loans are good when you are starting your business out. For example, for my dentists, for my logistics operators that are in the logistics business where you need equipment, right? That's important to perhaps get an SBA loan. The SBA is used to working with small business owners. That's what they're there for, to further small business. You can also get a loan by factoring your receivables. Factoring your receivables means you have clients that owe you money in your business. So let's say, for example, in my type of business where I invoice clients monthly, and say that those clients pay me every 30 days or every 60 days. If I factor my receivables for financing, I am saying to my lender, to the bank, to the finance company, this is how much I have in receivables, 50,000, 100,000, whatever the case may be. And the bank may decide, okay, Carla, based on your receivables, we are going to give you a factoring amount. We are going to allow you to have up to 25% of your receivables every single month. So if my receivables are 100,000, the bank may be willing to give me 25,000. I'm factoring my receivables at a rate of 25%. So there's all sorts of ways that we can get loans in our business. But the key is really understanding if these types of loans are suitable for you. Because when you are factoring your receivables, they are going to want you to pay them on a more regular basis than a monthly payment. Typically, when you're factoring receivables, they're going to take money out daily, sometimes every 2 weeks, sometimes once a month. So this is for businesses that have revenues coming in every single day. My econ type of businesses, businesses that have invoices going out to clients that are paying you on a regular basis, 30 days, 60 days, and your clients are doing residual business with you. Then you can actually factor your receivables. That's also important. The other item I want you to learn about is learn about the requirements for qualifying for a business loan, right? That's also important. In order for you to qualify for a business loan, you got to have a couple of things. Number one, you got to have a good credit history. You as an individual and even you as a business owner, if you're just starting out. There is no bank that is going to just give a business money without there being some type of credit history. That's why it's important to start building that up. So that's the first thing you have to have. The second thing you have to have is you got to have some type of financial statements. I mean a profit and loss, something that shows your income and all the expenses associated with it, plus a balance sheet. And a balance sheet shows your assets, cash in the bank, equipment, inventory, and your liabilities. How much money you owe to whom, and your equity in your business. So you got to have those two things in order for you to be able to get a business loan. That's a requirement of a loan. And if you are wanting to get a business loan, you might also need to do a personal financial statement. That means that I need to do a financial statement as to myself. Where's my income coming from? What are my assets? Because in the beginning, maybe my business doesn't have enough to get me that loan. So understanding a PFS, personal financial statement, is important to you, and understanding this terminology so when the bank asks you for these things, you'll know exactly what the bank is talking about. You may even need to personally guarantee that loan or put up some personal collateral, perhaps a car that's paid off, perhaps them allowing you to put collateral against your primary residence or a piece of rental property that you own, and only for a time period, not forever. If you are going after a business loan, make sure you understand the terms so that you're not locked in forever. Let me out! When you are dealing with business loans, you got to understand that these banks are going to register you as having a loan with them. Therefore, they're going to want to see your legal documents. Do you have a business license? Are you registered with your local county as a proprietor. Even if you are a sole proprietor, do you have a business license with the city in which you're doing business in? Is your business registered with the state? Do you have an EIN number? If you say you are a business, you better have a business bank account with your business name on it, because the bank is just not going to lend you money because you say you're in business. They want documentation to prove that you're in business. So all of these things really become really critical for you when you are going after a business loan. Now, when you're thinking about getting a business loan, you got to decide, are you going to go to a traditional bank where you're going to walk into that bank or do business with them? Are you going to get a loan from an online bank? Are you going to go to a credit union? Are you going to go to the SBA? Where is going to be your best bet to get a business loan at the proper stage of where you are in your business? So many business owners are telling me they're being turned down for loans. You know why? Because you're not going to the proper lender. You're trying to walk inside a Bank of America or a Wells Fargo, but you're not there yet. When you're thinking about getting a loan for your business, the real key takeaways are understanding where you are in your business, whether you're in the development stage, whether you're in revenues, whether you're in the growth stage. That's very important. Making sure you have a use of funds schedule, making sure that that loan is going to get you further, faster to where you are really trying to go, evaluating the proper lender to actually go to, understanding all the costs associated with acquiring a loan. And here's the thing. For me personally, when you are just starting out trying to get a business loan, I am going to highly suggest you start out with the Small Business Administration. Why? Because whether they give you a loan or not, they are going to put you with a mentor, somebody probably from SCORE that's going to help you as a business owner. They're going to require you to put together a business plan, and they're going to help you do it. They're going to help you create a use of funds schedule. And whether or not you get the loan with the SBA or not, doesn't really matter. You know why? You're going to have a packet of everything that you're going to need to go to online lenders, to go to a factoring company, to go to a bank. That's why I love starting out with SBA. And here's the thing, now that you know better, you absolutely got to do better, which is why I want you to like, I want you to subscribe, and I want you to comment so that I can continue to keep you updated on all things business and tax.